China has clarified that it has no plans to trim the U.S. bond buying after reports of Beijing's plan to go short on the U.S. Treasuries sparked investor worries. With forex assets of over $3.1 trillion as of 2017 end, China is the world's largest foreign holder of U.S. Treasuries, and a decision to unwind USTs could have a big repercussion in the currency markets across the world. In fact, my colleague Tanveer Gill joins in with more on this big story. Tanveer, what exactly is the stance coming in from China, and what's going to be the overall impact on the bond and the currency markets?
Well, earlier yesterday overnight, there was news that gripped U.S. bond markets indicating, and this was source-based of course, that Chinese authorities were looking at either slowing down or completely pausing incremental purchase of U.S. Treasury yields. On the back of this story, we saw U.S. Treasury yields spike, in fact go past 2.5%. 3%, remember, for U.S. Treasury yields. It turns out to be a bit of a tricky point because it leads to risk aversion in global asset classes, as we've seen in the past. So that build-up in Treasury yields got the market to sit up and take note at a time when equity markets world over have been rallying as though there's no tomorrow. So in lieu of the contrast that's being played out in the bond markets, where there's extreme skepticism, versus the equity markets where there's extreme optimism, one was a bit concerned about what China's stance would do for overall sentiment when it comes to investing in global markets. China, of course, it was again indicated, had stated, and Chinese officials were quoted on this matter, that they either thought that strained U.S. trade relations with China were the reason to step back on these asset purchases, or the fact that they did not find U.S. Treasury markets or U.S. bond markets attractive enough, and were looking at some reallocation to their $3.1 trillion foreign exchange reserve. These were seen really as the trigger points for their decision. However, the Chinese Foreign Ministry sprung into action and came out with an official clarification saying this news is fake and doesn't hold merit, is not material at all. And that, I think, would just mean that when the U.S. markets open next, that there would be some semblance that will come back to the markets, and it would be business as usual, while the dollar and the yuan compete as two of the dominant reserve currencies of the world. For now, this issue has been put to rest, and has been arrested from the point of it spiraling out of control and leading to more damage in world market sentiment. So for now, it's a done and dusted story.
Thanks very much, Tanveer, for giving us all of those details. So clearly, China clarifying on the false alarm and its stance when it comes to bond buying.